So we're going to talk about 7 mistakes that are pretty common in cryptocurrency. You may well be on this list. Hi everyone, if you're new, make sure you subscribe, hit the bell button and leave a like. Now, I'm getting a new green screen today. I'm really excited about it. You probably won't be able to cut off my elbow anymore and stuff like that, which will be good. So, again, we're talking about 7 very common mistakes. I want to go through them, try and show you how to overcome them, basically. Might be a good video, so make sure you do leave a like. If you do enjoy my content, please do subscribe, come back for more. Now, as I say, these are very, very common. They're very, very obvious as well when you start pointing them out. So like anything, I'm going to talk about them, I'm going to go through them, and I'm going to make it nice and simple. First one is too many different types of coins. You are not in the scouts. You are not trying to collect 50 different coins, because why not? When you do that, it opens up more issues and more mistakes and more problems, because 1, you probably got FOMO. 2, you're probably thinking that you're going to get rich and look for the 100x gems, which I could have easily put it on there, but realistically kind of covers it anyways. So I go through a mechanism called quantity. I would rather have quantity of quality versus, well, quantity of shit, basically. Let's be honest. I mean, what more do you want? You want a good, solid, strong asset, and you want lots of them to potentially get more wealthy, right? That's kind of the game. Why put $50 in 50 coins? Because it doesn't really work. It's not an index. You could do it that way if you wanted to, but it's not really worth it. Especially when you think, right? 3 months ago, Ethereum fees were blew up, right? Crazy. You try liquidating your position. You try selling at a profit in those and having to do multiple transactions. Yeah, good luck. Wouldn't happen. Anyways, so number 1, too many coins is a very, very common mistake. In my opinion, this is what I do. You don't have to do this. I have Bitcoin and I have 6 altcoins only. It's hard, very hard, but it allows me to have good risk management. It allows me to have certain things, and risk management I will come on to in a bit, because it's all about percentages, right? The next one, buying through a parabolic phase. I've just booted the chair there. So, why is this so important? Too many people are buying when the euphoric feeling of, oh my God, we're going to make so much money. That's the worst time to buy. You need to buy low. And it sounds really dumb saying this, and I do apologize if I'm teaching you how to suck eggs. You got to buy when people are not interested, when they're not wanting it, when it's horrendous. You got to think, Ethereum was $4,000. Someone somewhere would have bought Ethereum at $4,000. You can laugh at them all you want, but at the end of the day, people do it. People get caught up in that emotion. People buy all-time highs. We're now currently under $2,000. It's like 50% off. Is it a good time to buy? Well, maybe not. You just got to wait and see. You got to wait for the reversal sign. But for me, if you bought in that parabolic phase, you've got to buy more lower. You've got to bring that dollar cost average down. So whenever you're buying, so say for example you bought up here, and if you buy down here, it will gradually move the needle down of your average dollar cost average, and you buy again. And it's a worse situation to be in, because you've got to put more capital in something that you physically feel like shit because you've just lost a lot of money. But one of the biggest common mistakes is people get in on the drive. This is where the wealth is. Not on the drive, it's on the way down. And it sounds stupid saying that, because you've got to teach yourself how to realize it, right? When things are low and no one wants it, and the prices are at a good, solid value, it's where you make the money, because you're buying as many coins and as many assets as you possibly can with good money, with risk management, when no one's interested. It's great. It's lovely. Who didn't want to buy Ethereum at $100? Well, me apparently, because I didn't. But we could talk about it in all different ways, but realistically, there's all kinds of coins out there. Now, number 3 is the other option. You could be great at number 2 in terms of, I'm not going to buy at parabolic stage, I'm going to buy when it's low. But I'm going to be that idiot that's going to hold my backs forever and not realize profit because I'm stupid. You need to take profit. I don't care who you are, what you're doing, right? If you are not going from unrealized profit to realized profit, you are stupid. Simple. Sorry, you are. Because Who doesn't want to make money? Who doesn't want to realize that I've just put, let's just say, theoretical thing here, you put in $5,000 into Ethereum in April 2020, right? Let's just say 12 months later, you are now sitting on, say, $150,000, maybe $200,000, whatever the sum may be, right? Theoretical values. If you are not thinking, I put $5,000 in, it's now worth $200,000, and you're thinking, I'm gonna hold it. Why? Even if you take out 10%, even if you take out 20%, enjoy your life. You've only lived here once. It's crazy when you think about it, right? So the most common mistake I see, and it is the most common, and I myself hold my hand up, and I will say, even in this last hype cycle, some stuff I should have took profits, I didn't, but I took profits on some stuff. At the end of the day, taking profits is key. Secure the bag. If you like Nando's, you'll know that phrase. If you get a Nando's takeaway, it says secure the bag on it. Remember it, right? That's why I like Nando's. So realistically, if you're not doing that, you are going to lose, because I've seen it before. I've seen people make loads and loads and loads of money, bragging about it, going, oh, look at this, it's awesome. And then 3 weeks later, it's gone. It's like a sieve. Boom. Anyways, moving on. Number 4, leverage trading. Now, if you know what you're doing, crack on. If you know what you're doing. But the problem is no one knows what they're doing. Well, they do. They do it, and then people try and copy, but they don't realize the mechanisms at play. Leverage trading works by 2 mechanisms only: risk management and money management. That is it. Low leverage, percentage of worth going into it. Simple as that. Keep it simple. So for me, I use a 3x usually, and I only use 1%. 1%, that is it. So I will put in 3 orders, and those 3 orders will usually accumulate to basically 1% or 1.5% of my entire balance. That is it for one trade. And if I win, well, I usually go for a 4-to-1 ratio. That's kind of the game I play, right? If you want to learn all that stuff, check out links below, right? Realistically, people don't do that. People go 100x, woohoo, woohoo, I want to get rich. And then they realize that, oh my God, I put 50% of my account on it. Oh, liquidated straight away. You need to learn what you're doing. Leverage trading is a great mechanism for growing wealth if you know what you're doing. You don't even need leverage in crypto. Realistically, that's why I use 3x. It just allows me to have less capital on the table. I can use the exchanges. It's great. Realistically, though, do you need to use leverage? As I say, no. But can you? If you want, go for it, right? You always need it if you're going to short it anyways. But realistically, if you're new, don't use it. No point. Next one is the obvious one. We're going to go back in time a little bit and go and press the back button. Market cap. Everyone, when you're new, I understand it, sucking eggs, but people don't get it. Oh my God, Dogecoin's only worth 23 cents. It's going to go to $2,000. You need to understand that the market cap is the overall value of what you should be looking at in terms of multiples for the long term. Never mind now, for the future as well. So that is basically the price multiplied by the circulating supply. You have got then, as I can show you, a fully diluted market cap there. On some of them it looks a bit different. Let me just show you a better version. I'll look at, I don't know, Litecoin. Gives you a better idea. There you go. So the market cap of circulation versus the market cap of total amount of coins out there, because realistically they're not fed into the circulation yet. Make sense? So if you're looking at an asset and it's like up at the top of the tree, the multiples are going to be less. They're probably more safe in terms of realistic expectations for the long term, because they might be like the likes of Ethereum or Polkadot or whatever. But if you go further down and you start looking at other coins and other metrics, you're going to think, well, what about if basic attention token doubles in price? Well, it's going to double in market cap as well. If it's $1, it's going to be basically $1.6 billion in market cap. Simple metric, but people forget it. The next one is no diversification. So going all in. If you want to go all in on one, yeah, but the chances are you're probably going to lose, unless you're literally just holding Bitcoin, which is a bit different. If you're going to go all in on Dogecoin, well, it could happen, right? Diversification is key in crypto because you've got multiple different types of coins and different types of situations in terms of use case, supplies, utility, all kinds of stuff. If you're going to buy every single payment processing coin, what's the point? If you're going to buy every single, decentralized platform in terms of like Ethereum or Cardano or Polkadot. Why? You've got to try and diversify with multiple different things. So maybe an exchange coin, maybe a payment mechanism, maybe an ecosystem type coin such as like of Ethereum. What about an enterprise blockchain? All kinds of other different situations in terms of use cases, utilities, different types of metrics, right? It's like the stock market. You can get different types of coins for different types of situations with different types of roadmaps, different types of everything, right? There's no point just going, I'm just going to buy Dogecoin. People do, but realistically, it's a very, very common mistake because one thing might pop, other things might not. DeFi may boom one month, NFTs might boom another month. Yeah, get a picture? The last one, I mentioned at the start, risk. Money you can afford to lose. Percentages. Now, I only put 2 to 3% into altcoins. That is it. My overall portfolio. Unless it's Polkadot. Polkadot's much higher. Zilliqa was 3%. It blew my portfolio to smithereens because it flew to the moon, right? But realistically, the time when I bought it, I only put 3% in. That's kind of the game I play. I hold majority Bitcoin. I hold stable coins. I hold Polkadot because I like Polkadot as a core hold. I think it's going to rival Ethereum in the future. So I'm going for it. That's kind of my risk appetite on there. However, other altcoins, 3% maximum usually. Some 1%, some 2%, depending on how low the market cap is, i.e. if this market cap is lower, the more risk involved, you want to put less in it. So, money you can afford to lose. I see too many people go, I'm going to put 70% of my value into the likes of Ethereum or whatever. That's fine, because it's a different kind of coin. However, if you're going to go, I'm going to put 70% of my worth into, say, I don't know, like anything. Like, I don't know, Telcoin or Quant or Near Future, or Near Protocol, sorry. Yeah, if that's for you, that's for you, but it's risky because if that project fails and you've got 70% of your wealth in it, and you've got to remember as well, look at these losses, 26%, 19%, 25%, 33%. Can you lose 70% of your portfolio? Where you look at Bitcoin, it's 15%. Bitcoin doesn't bleed out as much, doesn't run and die as much. It's one of those things, right? So, important lessons. I hope those have helped as a listening exercise more than anything. Write them down, take note of them. They are very, very simple to kind of comprehend when you get your head around it, but you've always got to remember the same thing. Buy as low as you can. Take profit. Don't have too many of them. Don't leverage trade. Don't risk too much money. And the most important thing, understand the market cap and have a little bit of diversification. Simple.